You may have been introduced to double entry accounting systems in an introductory accounting class. The account balancing systems used for your personal financial management efforts apply equally to the balance of payments used for the United States government and every government in the world. We will explore the balance of payments as you become comfortable with how certain data are entered on one side of the register, while other data are entered in a balancing account.
U.S. trade deficit jumps to a near 5-year high. The Commerce Department released new data on Tuesday, March 7th, showing the figure rose 9.6% in January. That's the highest level since March of 2012. Picking apart the numbers, there was a $48.5 billion gap between what the United States exported and what it imported. Still, other countries bought 0.9% more goods made in U.S. factories in the first month of the year than in December. The U.S. exported $1.3 billion more in automobiles and $2.1 billion more in industrial supplies. Meanwhile, on the import side, cell phones and rising oil prices pushed up the bill. The wider trade gap adds to weak data such as housing starts, consumer spending, as well as construction spending. All figures suggest the U.S. economy struggled to regain momentum early in the first quarter. For Newsbeat Social New York, I'm Rumi Fukushima.
During our walk through this International Accounting short course, we will investigate titles for several accounts used to categorize spending and income categories as we understand how global transactions fit into these categorical terms. We will begin our acquaintance with international trade monetary flows by considering the nature and significance of a nation's balance of payments. We will discuss the concept of the balance of payments within an overview of double entry accounting and the major credit and debit transactions on each nation's balance of payments statement, and explore what these concepts mean to our domestic economy. The U.S. current account and capital account are the linkages between our country's current account deficit or surplus and the net foreign investment position in national income accounting. All of these accounts are joined on the U.S. Balance of Payments Report and the U.S. Balance of International Indebtedness Report. We will gain a better understanding of how these reports are described in the media by politicians and bureaucrats, and how they are used by businesses to manage the financial position of companies and the government. As an economist, you will be in a unique situation to grasp differences between the numbers, interpret their importance, and position yourself for anticipated effects. We begin with the idea of a personal budget, finances, and balancing your bank accounts. The accounts always balance, even if your money management skills need improvement. Think about your personal checking account. Paychecks are deposited into it. You write checks to pull money out for expenses, investments, and other costs. You may have a separate savings account, credit card account, and maybe even some investment accounts. All of these are combined into your personal balance of payments. If you overdraft your checking account, your check may be returned to the store as no sufficient funds, or you may receive a deficit on your account for the amount of the overdraft, plus a bank fee. Your checking account may be in a deficit position, but your balance of payments will be equal. You took responsibility for the overdraft as an entry in the debt column. The balance of payments is zero, but your checking account is negative. A nation's balance of payments is a record of the nation's economic transactions during a stated period of time, generally in calendar year increments. Credits and debits are generally used to identify which column totals are entered through double entry accounting techniques. For a nation, a credit transaction is one that results in a receipt of payments from foreigners, whereas debt transactions lead to a payment destined for another country. In terms of countries, the financial activities of the people in that country determine the nation's overall position on the balance of payments. These economic entities include all residents, such as people, landed businesses, and levels of government from cities, states, and offices of the federal government. International transactions include exchanges of goods, services, or assets between residents of one country and those of another. Your visit to Canada, when you rented a hotel room, paid for fuel, bought some food, and attended a sporting event. is entered as an international transaction series. You are a landed citizen of the U.S. who bought funds across the border to purchase the things you acquired, goods and services. Your purchases while in Canada are considered credits by Canadians determining their balance of payments. On the U.S. side of the transactions, when calculating the U.S. balance of payments, your sending of funds abroad is considered a debt payment. Taken together, the balance of payments equals to a zero balance. Operationally, the balance of payments details economic activities as current account transactions or as capital and financial account transactions. Accounting practices used in double-entry bookkeeping are applied to personal finances, businesses, and all levels of government, all the way to the global scale as trade balances and account balances are determined. Double-entry accounting practices are founded on the premise that all balances can be identified as a credit or a debit and entered appropriately in the proper ledger. When we talk international economics, a credit transaction is one that results in receipt of payments from foreigners. A debit transaction is one that leads to a payment to foreigners. By convention, the credits are stated with a plus sign, while debits are recorded with a minus sign. Keep your attention on the statements of capital for goods and services in terms of which country your balance of payments is being credited for. If I represent an American company who is paid by a Japanese company for consulting services, then the payment, say $100,000, is entered as a credit transaction to the American balance of payments account, while it is a debit for the Japanese balance of payments account. Just as we consider our personal checking account, savings account, credit card balances, student loans, and other accounts as part of our personal balance of payments statement, we extend these concepts to the U.S. balance of payments structure. Think of these categories as sub-accounts, each using double-entry accounting procedures. We will first look into the current account. This reports monetary values of international transactions in goods, services, income, and unilateral transfers between countries. It includes monetary flows between nations as payments for goods and services, investments in businesses or securities, or for the purchase of durable goods like land. We start with the accounting of goods traded between nations. The merchandise trade balance only includes international trade in goods. It neither includes services nor capital transfers and foreign investments. Official merchandise trade statistics measure the annual changes in total export and import trade. The merchandise trade balance is often used as an indicator of the overall health of the U.S. economy. As an informed news consumer, be cautious and avoid misinterpreting a merchandise trade deficit as an overall trade deficit. Be careful about the naming conventions. A little word omission changes the meaning drastically. This happens when the members of the media use the term trade deficit interchangeably with merchandise trade deficit, which may distort correct interpretation of the actual numbers. The term goods and services includes significant U.S. economic services such as tourism, international consulting, financial services, transportation, and telecommunications. It is important to know that merchandise trade only refers to trade in goods, whereas trade deficit refers to balance in both goods and services. In this case, even if the U.S. is running a merchandise trade deficit, it does not mean the economy is not doing well. It can be a net importer of goods, but a net exporter of services. As the name implies, the capital and financial account is organized in two sub-accounts, the capital account and the financial account. Assets represent claims on residents and liabilities represent indebtedness to non-residents. Capital transfers consist of those involving exchange of ownership of fixed assets, transfer of funds linked to the acquisition of fixed assets, or cancellation of liabilities by creditors. The capital and financial account does not include land exchanges within a country, but it does include the sale or purchase of rights to natural resources, even if those natural resources are attached to the land, like timber or minerals. It also includes patents, copyrights, trademarks, and associated intellectual property. The Official Settlements Transactions is an official settlement account that records transactions of foreign exchange reserves, bank deposits, and gold at a central bank, such as the U.S. Federal Reserve and the Bank of England. For example, the U.S. Federal Reserve uses official settlement accounts to keep track of its transactions in gold, dollars, or other assets with central banks located in other countries. The official settlement account is a crucial component of the nation's balance of payments. Though the account may keep track of specific transactions, it also helps record a country's assets with other banks, whether it is running a deficit or surplus in those assets, and the movement of dollars to foreign recipients. These figures are used to track a country's ability to respond to a currency crisis and to stabilize currency exchange rates quickly as needed. Official reserve assets include foreign banknotes, foreign bank deposits, foreign treasury bills, and short and long-term foreign government securities. International commerce commonly adds gold reserves, International Monetary Fund reserve positions, and special drawing rights, or SDRs. Official reserve assets allow the central bank to purchase their own currency in order to regulate its international availability, thus influencing its open market exchange rate. Currently, the United States has a managed floating exchange rate that is viable within normal market forces, so the purchase of U.S. dollars by the USA is not generally necessary, but it is an option. Special drawing rights, or SDRs, were introduced in 1969 by the IMF as a special mechanism to supplement existing financial reserves management of member countries' currencies. As an internationally valued commodity, they can be transferred among participating countries in settlement of balance of payment deficits or to stabilize exchange rates between currencies. A country participating in this system needs official reserves, such as a government or central bank holdings of gold and widely accepted foreign currencies, to purchase their domestic currency in foreign exchange markets, as required to maintain its exchange rate. The use of SDRs is limited only to IMF member nations' governments. They are not available to private companies or to individuals. Most countries' currencies have migrated to floating currency exchange rates and lessened the need to encumber SDR exchanges. However, during the recent Great Recession from 2007 to 2009, IMF allocations totaling 182.6 billion SDR units played a critical role to provide liquidity to the global economic system and supplement member countries' official reserves. This mostly unrecognized IMF currency globally lessened the cascading devaluation of currencies. Recovery of critical market financial systems efficiently rebounded.
The special drawing rights, or SDR, were created to supplement existing reserves of IMF member nations to help boost global financial liquidity. At first, its value was pegged to the price of a unit of gold, which was also equivalent to $1 US. In 1973, the IMF decided to link SDR value to a basket of currencies after the US dollar was deemed overvalued. Today, it includes the euro, US dollar, UK pound, and Japanese yen. The IMF allocates the SDRs among its member countries. Members can then buy or sell SDRs between them and exchange them for freely usable currency, one that's widely used in international transactions and easily converted in foreign exchange markets. The total value of SDRs is $280 billion, about the size of Chile's economy in 2014, the 42nd biggest economy in the world. The basket is reviewed every 5 years to determine if new currencies should be added.
A fundamental requirement of the double entry accounting process is that the balance of payments accounts always balance. In practice, these balances are made using values reported from several sources, in several locations around the world, and rarely do they perfectly match to create the required equivalency. But they should match, so sometimes they are made to match. When summed together, a statistical discrepancy is entered into the accounts to force their equilibrium. It can be challenging for the accountant to enter the adjustment correctly through the use of offsetting factors or single-column alterations.
The balance of payments, or BOP, is a record of all payments or monetary transactions between a particular country and other nations during a specific time period. It provides a useful glimpse into the economic relationships between different countries around the world. The BOP account is broken down into 3 separate categories. The current account includes any exchange of finished goods and services, such as tourism, for consumption purposes. When Nali Nation sells goods or services to Gali Galaxy, the payments made to Nali are recorded as a credit to Nali's BOP and a debit to Gali's BOP account. The capital account tracks movement of capital going in and out of a country for investment purposes. When a Gallian migrates to Nali Nation, the items of value he moves into the nation with him represent a credit to Nali's account and a debit to Gali's BOP account. Lastly, the financial account records payment flows related to the change of ownership in international financial assets and liabilities. The flows include direct investment, portfolio investment, and reserve assets, which are purchased and sold only by monetary authorities. When Nalians invest in foreign securities from Gali Galaxy, this effects a debit to Nali's BOP and a credit to Gali's BOP account. A country's BOP should be 0. That is, the current account should balance with the capital plus the financial accounts. However, statistical discrepancies, differences in accounting practices, and exchange rate fluctuations mean that this rarely happens. One major benefit of the balance of payments is that it allows a country to identify any long-term trends that could be troublesome to its economy. By understanding its BOP, a nation has the potential to create policies that will put it on the right track.
The U.S. balance of payments is an accounting record of all economic transactions between U.S. residents and the rest of the world in a particular period, generally every year. The transactions entered into the master ledger are the dealings made by individuals, firms, and government bodies. It represents a summation of the country's current demand and supply of the claims on foreign currencies and of foreign claims on the U.S. dollar. It is a settling board on a global level. Transactions include payments for our country's exports and imports of goods, services, financial capital, and financial transfers. Sources of funds for the U.S., such as exports or the receipt of loans and investments, are recorded as positive or surplus items. The use of these funds may be destined for imports or to use for investments in foreign countries. In the ledger, they are recorded as negative or deficit items. When all components within the balance of payments structure are counterbalanced, they will sum to 0, with no overall surplus or deficit. For example, the U.S. imports more than it exports. Its trade balance will be reported as being in deficit, but the shortfall is counterbalanced. Offsetting factors include funds earned from foreign investments, depletion of central bank reserves, or when receiving loans from other countries. The latter option has been exercised often by the U.S. government because this option is directly within its immediate purview. It can happen without an act of Congress. The overall balance of payments will always balance, with all types of payments combined. Imbalances are possible on individual subaccounts, such as the current account or the capital account. The term balance of payments often refers to this sum. The country's balance of payments is said to be in surplus by a specific amount if sources of funds exceed uses of funds by that amount. There is said to be a balance of payments deficit if the former are less than the latter. A balance of payments surplus is accompanied through accumulation of foreign exchange reserves by the central bank. Under a fixed exchange rate system, the central bank accommodates the flows by buying up any net inflows of funds into the country or by providing foreign currency funds to the foreign exchange rate market to match any international outflow of funds, thus preventing the fund flows from affecting the exchange rate between the country's currency and other currencies. Think of this mechanism as a flow moderator, preventing excess or scarcity in the exchange caused by normal business operation fund flows. The capital and financial account is intertwined with the current account, and their balances are offsetting within the double entry accounting principles. If the current account registers a deficit, the capital and financial account must register a surplus. Their balances offset each other. When the U.S. imports more goods from other countries, our current account moves into a deficit position, while our capital and financial account shows us as a capital borrower from the rest of the world. Current account deficits are often reported separately from the capital and financial account balances, giving the impression of an insufficient balance of payments. Governments deal with a current account deficit caused by an excess of imports over exports, thus borrowing funds from citizens of other countries and selling assets to other nations. This is not a passive exchange of goods and services for cash. Governments seek affordable and desirable goods and services, just as they seek attractive investments broadly established where the trade-off of security and growth are combined. The U.S. financial markets represent such a mix of foreign global investments because of the comparative advantage offered in the U.S. financial markets for low-risk bonds, securities, and other investments with commensurate returns on investment. Combined with the stable U.S. dollar currency, this attracts international investments, placing foreign currency investments into our national balance sheet. A U.S. current account deficit was seen in the 1980s, caused by a massive financial inflow. It was the result of an increase in the U.S. interest rate relative to the interest rates in other countries. The U.S. became desirable investment grounds. The higher U.S. interest rate happened as a result of three factors. A. The government's growing budget deficit. B. A decline in the private sector's saving rate. And C. The U.S. government's offer selling bonds at globally attractive terms. At the time, domestic savings were suppressed, and the demand for foreign investments in the U.S. necessitated an increase to the interest rates offered. The deal got better. These moves attracted foreign investments to the U.S., and the current account deficit increased. Capital inflows contribute to the current account deficit. At the same time, current account deficits drive capital flows into the U.S. Capital inflows keep the U.S. dollar stronger than it would otherwise be, increasing our domestic demand for foreign imports and suppressing domestic exports to other nations, thus continuing the current account deficit cycle. Is this prolonged period of current account deficits in the U.S. a problem? Well, I think it depends on who is asking the question. As a general consumer, the current account deficit means that people, businesses, and the government are spending income on foreign-made goods and services delivered to our markets at a cost lower than we can produce for ourselves. This is a major cause of the net increase to our current account deficit. The patterns ebb and flow with recessionary and growth spurts in our economy and in those of our trading partners. As long as consumers can afford to consume imported goods, they will see this as a desirable advantage. We can enter into a current account deficit period. We also experience an increased inflow of foreign capital, and the U.S. becomes a net borrower of funds from the rest of the world. This movement of foreign capital to the U.S. makes capital more plentiful, and in turn, suppresses interest rates domestically, making investment funds more available and less expensive to U.S. citizens and businesses. This encourages business investments and borrowing, giving increased growth potential to U.S. companies. To follow this pattern a little bit further, we can say that U.S. companies and individuals may be attracted by the availability of cheap loans. But long-term growth and stability hinges on how that capital is invested, grown, and repaid to its creditors. In the 1990s, this situation favored the U.S. economy as funds were used to grow businesses, while expanding employment, net output, and national welfare. This is a topic worthy of more investigation. We will revisit it again in just a few minutes. The efforts of international accounting might be in need of some housekeeping services. Apple Computers, an American company, developed the iPhone by combining cellular phone services with photography, videography, and internet browsing, building a culture of applications held in the hands of everyone under 40, or 50, maybe even 70. When mass production was initiated, the lowest cost providers for the device were assembled from half a dozen countries, with China providing the service of the final assembly. Trade statistics in the U.S. shows that in 2009, the iPhone increased the U.S. trade deficit with China by $1.9 billion. That's billion with a B. The device components were manufactured in several Asian and European countries, and the United States, along with China, completing the final assembly and shipping completed products to the U.S. Chinese contributions to the iPhone are about $6.50 per device, out of $180 total. Yet, the total imported value of the devices is treated as a Chinese export to the U.S. What's up with that? Is the iPhone really a Chinese export sent to the U.S.? Remember, many of the iPhones are sent directly from China to Europe, never passing through U.S. customs ports. Changes in the national and global economies cause businesses to alter their positions as borrowers, investors, or growth agents. At the beginning of this decade, in 2010, the U.S. was struggling through the Great Recession as it spread through many countries and consumer savings and investments declined. Families and businesses alike adjusted to the economic pressures by reducing consumption and focusing on immediate needs, foregoing investments, and trying to preserve their savings. As a result, the U.S. current account balance caused the trade balance to improve. Looking deeper under the hood, we can see a double-edged sword of this improved trade balance. U.S. imports fell during the Great Recession because domestic consumption was muted. Taken further, the current account and overall economic performance effects can be viewed both in a short-term and long-term perspective. During rapid economic growth cycles, nations possess long-run current account deficits, while countries with weaker economic growth have long-run current account surpluses. In general, rapid economic growth and strong investment opportunities go hand in hand. The nation may welcome the combination of rapid growth and profitable investment opportunities with national investments in the domestic economy and open accounts for foreign investment. Foreign investments create financial inflows and a current account deficit. Successful domestic growth enabled by domestic and foreign investments results in increased domestic output and employment growth. When exports increase from expanding domestic production, foreign investments are repaid, and the current account surplus is seen. Since the 1970s, the U.S. has moved from the status of a global investor to the reputation of a large net debtor. Our country entered the phase of an ever-accumulating national deficit, crossing the $2 trillion mark in the early 1980s, then $7 trillion in the 90s, $10 trillion at the turn of the century, and now passing the $20 trillion threshold as it surpasses the U.S. gross domestic product. Much of this debt is funded by foreign investors seeking the combination of a stable investment and political environments, combined with attractive risk portfolios and commensurate rates of return. Overall, the combination of factors is better than most can achieve in their home markets. Simultaneously, China, as a major trading partner with the U.S., invests in U.S. securities, relaxing the U.S.-China balance of payments. China's investments in the U.S. eases the pressure on yuan against dollar, keeping Chinese production attractive to U.S. businesses. All combined, the U.S. has so far sustained its reputation as a good place to invest capital. Conversely, U.S. businesses with this positive investment potential under their belt have sought offshore investment horizons to combine low-cost worker alternatives and affordable commodities with higher potential rates of return moderated by higher risks. These asymmetric investment returns have benefited U.S. companies and international governments. Foreign investors still seek the security of U.S. portfolios, while U.S. companies can seek the higher risk and higher returns potential from offshore investments, made possible by the safe haven of their home country, the USA. Current account deficits, international trade, cheap foreign labor, and offshoring come together in discussions over the U.S. loss of jobs. All countries involved in free trade have faced the issue of foreign-made goods entering their markets at the expense of domestic job losses. Bottom line, if an American purchases something made in another country and shipped here, they are favoring a foreign worker at the expense of equivalent domestic jobs to make that product. Conversely, when a good an American makes is exported to another country and a foreigner purchases that good in their market, they are favoring the American company at the cost of their employers and employees. These all come out in the trade deficits of nations, with surpluses to some and deficits to others. Across the U.S. economy, deficits are matched by equal inflows of foreign funds, sustaining investment spending that would otherwise not occur. This supports employment-sustaining and investment funding that otherwise would not occur. Foreign investments in Treasury securities suppress long-term interest rates, helping to stimulate the U.S. economy. Foreign investments in stocks and real estate put dollars under the control of American sellers, who spend the capital domestically. Domestic economic activity is promoted. A current account deficit promotes jobs for the domestic economy from direct effects of higher investment industry employment, and from indirect effects of higher investment spending on economy-wide employment. As we take these thoughts across the topics studied thus far in this class, consider the changing trends of international competition and comparative advantage factors. During the past 50 years, the U.S. has moved from a leadership position in manufacturing, like the automotive industry, to watch Japan take the dominant market position globally. The quality of life in the U.S. has improved substantially over the same period of time, as American output and employment in the service sector has increased. Current account deficits do not cause a net loss of jobs or output in the overall economy. They tend to change the quality of output and employment structure.
As cell phones and rising oil prices helped to push up the import bill, the U.S. trade deficit jumped to a near 5-year high in January. The rise suggests trade would again weigh on economic growth in the first quarter. The Commerce Department said on Tuesday the trade gap increased 9.6% to $48.5 billion. It is the highest level since March 2012. December's trade shortfall was unrevised at $43.3 billion, and the deficit was in line with economists' forecasts. When adjusted for inflation, in December, the trade deficit rose to $65.3 billion from $62 billion. Both the inflation-adjusted exports and imports were the highest on record in January.
The U.S. has benefited from a surplus of savings, as opposed to investments, from many countries of the world which provide funds to the U.S. balance of accounts. American assets, like Treasury securities, under the current account deficit column, have been bought by foreigners willing to invest money in the U.S. Since the 1990s, the U.S. experienced a reduction in the rate of domestic savings and an increase in domestic investments. Think about a working professional contributing to a personal retirement account invested in the stock market. This is treated as an investment, and most working professionals are doing it. The large increase in the U.S. current account deficit would not have been possible without the accommodating inflows of foreign capital coming from nations with high saving rates. Is this trend sustainable? It might be, or it might turn upside down. The recent tendency of the U.S.-based investments being attractive has been possible because of the factors discussed previously, including political reliability, positive economic growth, and favorable investment conditions. If these can be sustained and even improved, indefinite-term current account deficits can be welcomed. Earlier, we talked about the current account deficit problem, indicating it would be tied to another situation. Well, this is that situation. The American economy, in its ability to cope with sustained current account deficits, hinges on continued improvements in domestic efficiency and technology. On the efficiency side, if the economy becomes more productive, its real wealth may grow fast enough to cover the huge debt. The recent increases in U.S. productivity have made its current account deficits affordable. If productivity growth stalls in the U.S., its ability to cope with the current account deficits will fade. On the technology side, in today's post-recession economy, the U.S. is witnessing a prolonged period of very low domestic interest rates. The cost of prime rate loans to businesses is fundamentally as low as it can go, and lower than it has been since 1971. The cost of commercial capital barely covers administrative expenses to manage the accounts. Yet these 2.5% interest rate loans have not been encumbered by businesses in sufficient volumes to spur what the U.S. Federal Reserve can call signs of economic recovery and growth. U.S. business performance does not show indications of widespread growth expectations. Well, at least, not yet. The U.S. economy was once known globally as a manufacturing nexus, supplying automobiles, machinery, iron and steel to buyers around the world, while also shipping agricultural and wood products to willing buyers. Business cycles explain how the U.S. has modified its position from being a global manufacturing core to a services-based economy. Long-term growth is difficult to achieve if the economy's service primarily recycles domestic funds to pay for domestic service providers. The unique integration of technology made possible by American know-how provides a globally marketable commodity capable of replacing our former manufacturing leadership position. Companies like the aforementioned Apple Computers, with Microsoft, IBM, and others, produce consumer and commercial equipment intended for everyday use, most often in entertainment, communications, and office productivity. These American-initiated products, with global demand, bring sustained return on investments back to the U.S. and offset America's current account deficit. In order for U.S. consumers to continue purchasing foreign goods, the domestic economy needs to be able to sell something offshore and bring foreign capital to our shores. Looking to the near future, electronics designed with domestically originating programming can be that link to the economic future. All nations have a fixed stock of assets and liabilities against the rest of the world, known as the balance of international indebtedness, and also called the investment position. It is a summary of all the assets and liabilities held by a government. The balance of indebtedness states that all assets a country owns, such as taxes not yet spent, corporate stock, government securities, and real estate. It includes all liabilities, including accounts payable to government workers, unpaid entitlement spending, and especially the national debt. You may consider the balance of indebtedness as the balance sheet for a country. When the accumulated value of the U.S.-owned assets abroad exceeds the value of foreign-owned assets in the United States, the U.S. is considered a net global creditor. When the reverse happens, the U.S. is considered a net global debtor. For over a century during the early stages of international development, the U.S. was in a net debtor position as foreign investments were made in the U.S., and funds were directed to industrial development. These development efforts were successful, and investors were rewarded with positive economic gains. The U.S. position changed after World War I to a net international creditor. This position was held until 1987, when it again moved to the position of a net international debtor. The most important switch can be credited to the attractiveness of the U.S. as an investment hub. Not only did foreign countries target American investment opportunities, but Americans chose the same options, avoiding offshore investments. The flow of investments in the U.S. was not solely due to favorable interest rates and low political risks, but also can be explained by the fact that investments in other countries were much less attractive. Does this debitor-creditor position represent any problems for the U.S. consumer? Most of us are unaware of the significance of the title. On one hand, the world thinks of the U.S. as a safe place to invest their capital and to save their funds. Most investing and saving Americans feel the same way. Some investors feel uncomfortable with the understanding that the richest nation in the world is simultaneously the largest borrower in the world. In your personal life, you may go through stages of borrowing for an education, automobile, and home. You will work to get ahead of the debt by increasing income to service the debt and make long-term savings. It is not advisable for a person or business to remain in an increasing debt position into perpetuity. Eventually, events will happen to catch you off guard, and substantial investments will be required to service the debt. Maybe the U.S. is now in that increasing debt position scheduled into perpetuity? If that mega deficit is not retired now, then when? The US dollar is a currency used around the world as a known value. In some countries facing rampant inflation, citizens exchange their domestic currency to hold US dollars as a means of retaining value. International exchanges can use the dollar even when neither trader is American, seen when a Brazilian company sells goods to a Mexican company and paid in US dollars. The most advantageous feature of the dollar is the level of comfort and familiarity other countries have in it as an international currency. For U.S. interests, it is a desirable position to be in. It means that international transactions cost us less because currency exchanges are not needed. Within the country, households can borrow money at lower interest rates, and the federal government can issue debt in dollars to foreign investors. Foreign investors are faced with a different angle on this issue, as the fall in the U.S. dollar's exchange value could wipe out the returns on their investments in the United States. While many foreign investors recognize this risk, it is China who holds the greatest exposure to a catastrophic loss. China has invested and saved substantially in U.S. securities, is a major exporter of goods to the U.S., and is concerned about possible loss of their purchasing power if the US dollar devalues. An American accident could cause a Chinese catastrophe, even a worldwide calamity. This trepidation is shared by many in the international exchange amphitheater. Let fears be felt, but the US dollar remains the world's default reserve currency. What are the options? Going back to our discussion about the official reserve assets, including foreign banknotes, foreign bank deposits, foreign treasury bills, short and long-term foreign government securities, gold reserves, International Monetary Fund reserve positions, and special drawing rights. Chinese economists proposed the use of an improved special drawing rights, SDR, to replace the position of the American dollar as an international reserve currency. Their approach is to make the SDR's calculation more robust by including additional currencies in the valuation mix and altering the weighting of each currency to a persistent level, thus eliminating swings by individual currencies in the short-term events. The IMF would be the official management organization. It could theoretically diversify currency risks and avoid complications brought on by persistently bad U.S. economic policy in terms of high deficit spending, increasing inflation rates, and currency depreciation. The new and improved SDR faces challenges of being an unknown quantity and for being backed only by good faith. But since the U.S. left the gold standard, the dollar is backed only by similar credentials. Keep your attention on this one. It may become a new global exchange reality, and when it does, the costs of trading will increase for U.S. companies.
The actual international use and trading of the renminbi, that it meets the conditions for being determined a freely usable currency. This is the second criterion. First one is based on trade, and the second is on the freely usable currency. This determination, which has been made today, will become effective on October 1st, 2016, in order to allow for the institutions, the central banks, and all users of SDRs to prepare for that new basket of currencies, which moves from 4 currencies to 5 currencies. The decision is effective. The renminbi's inclusion is clearly an important milestone in a journey that has begun months, if not years ago. A journey which is a transition towards more market-driven principle of the macroeconomic framework of China. It's a milestone in a journey that will continue indeed, and will include certainly more reforms that will add to the existing reforms that have been decided by the Chinese authorities in the last few months. It's also a journey for the institution. We have worked very hard in the last few months. We have tried to cooperate as much as possible with the Chinese authorities, with authorities around the world which are users of SDRs, the BIS, with data collectors. And this journey will continue, because we will indeed continue to monitor that all criterions and compliance from all authorities of all 5 currencies actually satisfy those criteria.
In this lecture, we examined monetary aspects of international trade by considering the nature and significance of a nation's balance of payments. We began by discussing the concept of the balance of payments with an overview of double entry accounting, while we identified the major credit and debit transactions on a balance of payments statement. We analyzed the structure of the balance of payments by considering its current account and capital account. This study emphasizes the linkage between a current account deficit, or surplus, and the net foreign investment position in national income accounting. All of these factors emphasize the U.S. balance of payments and the U.S. balance of international indebtedness. Of particular importance is the United States as a debtor nation in the views concerning the effects of persistent U.S. indebtedness.